Materiality. The definition of materiality is information is material when the misstatement could influence the economic decisions of users taken on the basis of the financial statements. Now, I'm gonna talk about the concept of materiality. Materiality is the criteria used by accountants and auditors in distinguishing between unimportant and important matters. Auditor is responsible to determine that the financial statements prepared by the management are free from material misstatement. If material misstatement exists, the auditor should bring the matter to the client's attention to take action to rectify such misstatements in order to give a true and fair view opinion on the financial statements. Accounts cannot be perfectly accurate and as such allow small error. Financial statement may contain misstatements, but not so large that could change decision. Sources of material misstatements are errors and fraud. For example, a misstatement of 1 million would be material for a small company, but may not for a large company like IBM. On the other hand, bases are needed for evaluating materiality. Because the materiality is relative, therefore, it is necessary to have bases for establishing whether misstatements are material. However, no specific rules or standard is provided in determining materiality. It requires considerable professional judgment by practitioners. For the policy statement, professional judgment is to be used at all times in setting and applying guidelines. The following policies are to be applied. The combined total of misstatement in the financial statements exceeding 10% is normally considered material. A combined total less than 5% is presumed to be immaterial in the absence of qualitative factors. Combined misstatement between 5% and 10% requires the greatest amount of professional judgment to determine their materiality. The 5% to 10% must be measured in relation to the appropriate base. The followings are recommended in selecting the appropriate base, which is first, income statement, second, balance sheet. Now, I'm going to talk about audit risk. Audit risk can be defined as the risk that an auditor may issue an unqualified opinion on materially misstated financial statements. In general, no auditor would purposely give the wrong opinion on the financial statement, but still, there is wrong occurrence for whatever reason. Auditor will, however, seek to minimize the risk of giving the wrong opinion. Auditor can reduce the uncertainty to a tolerable level through adequate planning, supervision, and conduct of audit in accordance with approved auditing standards and also firms' quality control policies in quality audit. Tolerable errors, uncertainty, or misstatement is the amount of preliminary judgment about materiality that is allocated to a financial statement. This is important matter for auditors as ultimately it will affect the auditor's profession, may cause monetary damages and bad reputation as auditors. Now, move on to acceptable audit risk, also known as AAR. It is a measure of how willing the auditor is to accept that the financial statements may be materially misstated after the audit is completed and unqualified opinion had been issued. There are three factors that cause uncertainty. First, nature of audit test. Second, inherent limitation. Third, persuasive rather than conclusive. In the audit risk model, there are three: inherent risk, control risk, and detection risk. For the inherent risk, it is the risk of material misstatement occur ignoring internal control system, while for control risk, it is the risk that internal control system will not prevent or detect and correct the error or material misstatement. Last but not least, detection risk. It is the risk that the auditor's substantive testing will fail to detect error or material misstatement. In general, detection risk has direct relationship with audit risk, but it has inverse relationship with inherent risk and control risk. That's all for audit risk.
Control risk is a material misstatement that could occur and not be prevented or detected and not corrected on a timely basis by the entity's internal control structure. Control risk also can be considered at two levels. The first level is general level. In this level, the auditor should consider attitude of management towards the important control systems of the company. The second one is specific level. In this level, auditor should also consider and evaluate whether existing control procedure is good enough to prevent and detect errors or not. We move to the inherent risk. This risk is relating to the characteristics of the business. Internal controls are ignored in setting inherent risk because they are considered separately in the audit risk model as control risk. Inherent risk can be considered at two levels. The first level is at the financial statement level or entity level. This level includes the nature of the client's business, size, and number of locations of the company, the management, unusual pressure on management, factors affecting the industry, and the initial versus repeat engagement. We move to the second levels of inherent risk, which is at the current balance and transaction level. In this level, it includes the result of previous audit, related parties, non-routine transaction, judgment required to correctly record the account balance and transaction, and also the other factors to consider. There are two terms in inherent risk. The first term is transaction level, where it relates to the test of transaction, while for the second term is account balance level, where it relates to testing for the item or balance actually exists owned by entity and proper valuation in the account. Detection risk is the only risk which can be directly controlled by auditor and depend upon his assessment of inherent risk and control risk. After assessing inherent risk and control risk, the auditor will consider the appropriate planning, direction, and supervision during the audit work, the nature of substantive procedures, the timing of substantive procedures, and the extent of substantive procedure. Okay guys, we move to the relationship of materiality and audit risk. There is an inverse relationship between materiality and audit risk. In other words, the lower the materiality level, the higher the audit risk and vice versa. Last but not least, I will talk about the concepts of materiality, which is quantitative guideline. There is no official guidelines on quantitative measure guidelines of materiality. For example, the materiality threshold for turnover, total asset, and equity is 1%, while for the materiality threshold for profit before tax is 5% to 10%.
Factors influencing determination of materiality. First, materiality is a relative rather than an absolute concept. When an auditor checks an item whether it is material or not, he needs to use his professional judgment to decide. For example, 30,000 ringgit is considered as material to a small company, but for a big company, 30,000 ringgit does not consider as material. Move on to the next factor. Bases are needed for evaluating materiality. For example, for a sales-oriented company, Their sales is the most important basis to determine the materiality. The last factor is qualitative factors. Example of qualitative factors are changing trend and conceal illegal acts. Application of audit risk model to audit work. At the beginning of the application of risk-based auditing techniques, the auditor must specify an acceptable low level of overall audit risk, and during the course of the preliminary review must form judgments about the level of inherent risk and control risk. The skilled and competent auditor will draw upon experience and knowledge of auditing standards to make a number of judgments. What is analytical procedures? The analysis of significant ratios and trends, including the resulting investigation of fluctuations and relationships that are inconsistent with other relevant information or deviate from predicted amounts. Nature of analytical procedures. First, among elements of financial information, such as gross profit and net profit. Second, between financial information and relevant non-financial information, such as payroll cost to number of employees. What is the purpose of analytical procedures? First, to assist the auditor in planning the nature, timing, and extent of other audit procedures. Second, as substantive procedures when their use can be more effective or more efficient than tests of details in reducing detection risk. And last, as an overall view of the financial statements in the final review stage or enhance the understanding of the entity's business. There are some possible reasons for the changes highlighted at the planning stage. First, an increase in the current ratio. It indicates increase in current asset. Company may be expanding or may be having problem to sell inventory or collection problem. Second changes is a decrease in the gross profit margin. It indicates cost of material increase or selling price decrease. The last changes is an increase in the inventory holding period. The company unable to sell inventory or company expecting additional sales, obsolete stock may rise or business expanding.
Next, we are going to discuss on audit sampling. Firstly, audit evidence. The auditor should obtain sufficient appropriate audit evidence to be able to draw reasonable conclusions on which to base the audit opinion. To form the audit opinion, auditor does not examine all the information available because conclusions ordinarily can be reached by using sampling approaches and other means of selecting items for testing. What is sampling? Sampling involves the application of audit procedures to less than 100% of items within an account balance or class of transactions such that all sampling units have an equal chance of selection. This enables the auditor to obtain and evaluate audit evidence about some characteristics of the items selected in order to form or assist in forming a conclusion concerning the population from which the sample is drawn. Express opinion in auditor's report. An audit includes examining on a test basis refers to the audit work carried on a sampling basis. Then, audit sampling can use either a statistical or a non-statistical approach. Sampling risk is that the auditor's conclusion based on the sample may be different from conclusion that would be reached if a 100% examination were carried out. For example, auditor testing on control procedures for payment cycle. Supposedly, auditors know client has 1,000 payment voucher during the year, and 50 of those payment vouchers are not properly approved. Therefore, if 20 representative samples selected, it should contain 19 samples correctly approved and 1 not properly
properly approved. But sometimes, from 20 samples, maybe contain 5 samples were not properly approved, or maybe all the samples are properly approved, considered immaterial at all. And auditor can lower the sampling risk by increasing the sampling size. There are two types of sampling risk. The first one is compliance test, and then under compliance test, there are two types of tests. First type is risk of assessing when control risk is too high. It is the risk that auditor will conclude that the risk is higher than it actually is. And the second type is risk of assessing where the control risk is too low. It is when the auditor will conclude that the risk is lower than it actually is. And the second type of sampling risk is substantive test. The first type of substantive test is risk that the auditor will conclude that there is a material error when in fact it does not exist at all. And the second type is risk that the auditor will conclude that a material error does not exist. In fact, it actually exists. The second type of risk is non-sampling risk. It refers to the factors that cause auditors to reach a conclusion other than the sampling size. For example, auditor rely on another representation of incorrect information. Other examples are like misinterpretation of evidence, human mistakes such as failing to recognize errors in documents, and applying auditing procedures that are inappropriate to the audit objectives. Bear in mind, non-sampling risk can never be a mathematical measure. However, to keep this risk to a minimum level, proper planning and supervision and follow the quality control standards is essential. Then we're going to talk about types of audit sampling. There are two types of audit sampling. The first one is statistical sampling, also known as probabilistic sampling, and the other one is non-statistical sampling, also known as non-probabilistic or judgmental sampling. So, let's talk about the first category of statistical sampling, which is attribute sampling. Attribute sampling is used to estimate the proportion of a population that possess a specified characteristics. For example, if you want to look for deviation rate. The most common use is for tests of control, such as auditor wants to determine the deviation rate for control implemented in accounting system or internal control structure. For example, examination on how often a credit check is not performed. For example, like before approval sales credit, we should check the credit availability of a certain customer before we process the customer orders or deliver the goods to them. And then, this measurement of deviation rate determines whether the internal control can be relied upon to process accounting transactions properly and support auditors' assess level of control risk. And the second category of statistical sampling is monetary unit sampling. It uses attribute sampling theory and technique to estimate the amount of misstatement for a class of transactions or an account balance. It is designed to test for overstatement errors and most appropriate for low error rate population of the sample results. And then the third one is classical variable sampling. It uses Snowball distribution theory to evaluate the characteristics of a population based on a sample data of which data should have equal chance of selection. Then determine the range of the data and selecting sample based on random table or computer audit software, which is currently practiced by most of big accounting firms for their big clients. The purpose of this third category of statistical sampling is to estimate the amount for a class transactions or account balance, and then to determine if a class of transactions on account balance is materially misstated or not. Since there are two types of audit sampling, an auditor needs to know when is the best time to use statistical sampling or non-statistical sampling. The decision whether to use a statistical or non-statistical sampling approach is a matter for the auditor's judgment regarding the most efficient manner to obtain sufficient appropriate audit evidence in the particular circumstances. These are the example situations where statistical sampling can be used. First, the client's accounting and internal control system are reliable and effective, and then the population are very large. Next one is when all items in the population are homogeneous, and the last one is when all items in the population are identifiable and accessible. On the other hand, auditor will use non-statistical sampling in other matters. So why auditors use non-statistical sampling? It is because part of the reasons is due to the auditor needs to consider the relationship between the cost of obtaining audit evidence and the usefulness of the information obtained. And the second situation is it is often less costly and less time consuming, but can be just as effective in satisfying audit objectives. Even though we have two types of audit sampling, actually there are few similarities between statistical and non-statistical sampling, especially in terms of steps of audit sampling application. For example, these two audit sampling are the same in terms of design of the sample, and then in the process of selecting the sample, in the process of performing the audit procedure, and also in time of evaluating the sample results. However, there are also differences between these two statistical and non-statistical sampling. For example, the first one is, for statistical sampling, the auditor needs to have knowledge on statistical formula. Meanwhile, for non-statistical sampling, auditor can do it based on experience and common sense. And the second difference is, what we get from statistical sampling is objective results. Meanwhile, for non-statistical sampling, we can get subjective results. And then the third difference is, from statistical sampling, different auditor with the same approach will give the same answer. Meanwhile, for non-statistical, different auditor will have different approach, and as a result, it will give different answer. The fourth difference is, for statistical sampling, it is an very efficient method and can delegate the responsibility to select audit sample to lower rank audit staff. Meanwhile, for non-statistical, it is not an efficient method and need more senior audit staff to devise the sample and select the sample. And the fifth and last difference between these two audit sampling is that statistical sampling is defensible in the court of law, meanwhile non-statistical sampling is not defensible in the court of law. Then we'll move on to the application of sampling on audit tests. It is regardless of whether statistical or non-statistical sampling is used, it is involving the common steps of application of sampling on audit tests. Basically, there are 4 steps in applying sampling on audit tests. So the first one is planning the sample, second one is selecting the sample, the third one is testing the sample, and the fourth one is for the auditor to evaluate the results from the audit test. So, for the first step, planning the sample, it involves the following steps, which is first determining the objective of the test, then define what errors or deviations are being sought, and then third, identify the population and sampling unit, next, stratification of population, and then deciding on the sample size. Then move on to the second step of sampling on audit test. So the second step is actually selecting the sample. The auditor can select the sample by using 3 types of sampling. First one is random sampling, and then the second one is systematic sampling, and the third one is haphazard sampling. And the third step is to test the sample or perform the audit procedures, which then lead to the fourth or the last step, which is evaluating the results.
That's all from us. Thank you. Bye-bye.